All right, so you want to get a handle on modern portfolio theory, huh? And you've sent us some really interesting excerpts from Martin J. Gruber's work.
Some great stuff in there.
Let's dive into this deep dive
Yeah, let's do it.
and unpack some of the key concepts together. You ready?
Absolutely.
First off, Gruber breaks down this idea of return. Seems pretty straightforward on the surface, but it's more nuanced than just did I make money or did I lose money?
Yeah, it's a lot more than that. Think of it as like a two-part equation. You've got the cash flow that you're receiving directly, like dividends from stocks or interest on bonds,
Right.
but you also have to factor in any change in the investment's value itself.
Okay, so let's say I buy a share of company X for $50. It pays me a $2 dividend, and then a year later I sell it for $60.
Yeah.
My total return isn't just that $10 profit, it's the profit plus that $2 dividend totaling $12, a 24% return.
Exactly. That's your total return. And that same concept applies across any asset you can think of,
Yeah.
from real estate to that rare baseball card collection you might have tucked away somewhere.
Now, anyone who's looked at their investment portfolio knows the future isn't exactly predictable.
Right.
Gruber really emphasizes that future returns are inherently uncertain, meaning we're dealing with probabilities, not guarantees.
That's where he introduces these two crucial metrics to help us make sense of all this uncertainty.
Okay.
The mean and standard deviation. They help us kind of summarize that potential range of returns without getting too bogged down.
So you mentioned in your notes you're a baseball fan.
Yeah.
Well, imagine for a second that we're trying to evaluate a baseball player. Knowing their batting average is helpful, but it doesn't tell you if they're a consistent hitter or if they strike out half the time.
Right.
That's where standard deviation comes in.
I like that analogy.
In investments, you need both pieces of the puzzle. The mean, or the expected return, gives you that average performance. But standard deviation tells you how much the actual returns could swing around that average. Basically, how bumpy the ride might be.
How much volatility you're in for.
Gruber uses some historical data to illustrate this. He found that over a long period, stocks delivered a much higher average return than bonds, but with a significantly higher standard deviation. Stocks averaged 12.2% return, but they swung around by 20.5%, while bonds were more like, say, a 5.8% return with a 9.4% standard deviation.
That really highlights that classic risk-return trade-off.
Mm.
If you want the potential for those bigger wins, you usually got to be prepared for those bigger potential dips as well.
And I think that's where a lot of people get spooked.
Right.
Seeing their investments drop in value and think, oh man, is my plan falling apart?
It's understandable. It's
Yeah.
totally natural. But, short-term volatility is like the weather. It's always changing. If you're in this for the long haul, those dips are just part of the journey. Think of it like a scenic route. You might hit some rough patches along the way, but the destination, that's what matters.
So how do we smooth out those bumps a bit? Is that where diversification comes in?
Absolutely. Diversification, one of the most fundamental, most important principles in modern portfolio theory.
Right.
And it does help smooth out that bumpy ride.
Gruber emphasizes that it's not just about spreading your money around randomly, it's about combining assets that don't always move in the same direction. Like, I think of it like having a team of rowers in a boat. If everyone rows perfectly in sync, yeah, you'll move quickly. But if one person makes a wrong move, that whole boat flips over.
You're sunk. Yeah. It's about building a portfolio where the ups of some assets can offset the downs of others. You're reducing that overall volatility without necessarily sacrificing returns.
And the data backs this up, right? Gruber shows that just diversifying from holding one single stock to 6 stocks reduces your risk by a whopping 71%.
Huge.
And you don't need thousands of different investments. Even just a handful of carefully chosen assets can make a big difference.
That's a key takeaway,
Okay.
especially for people who might feel overwhelmed.
Right.
Like, oh, do I have to own hundreds of stocks? No. A well-diversified portfolio doesn't have to be super complex.
All right, so we've diversified, our portfolio's humming along, but now I'm thinking, is this the best portfolio I could have, or am I missing something?
That's where the concept of the efficient frontier comes in. And this usually represents all those possible portfolios you could create. Imagine it like a map of all the possible routes you could take to reach your destination.
So the efficient frontier is the route that gets you there with the most scenic views for the level of risk you're willing to take.
Precisely. Any portfolio that's below that efficient frontier line, it means you're either getting less return for the same amount of risk, or you're taking on more risk than you need to for the return you're trying to get.
And Gruber's pretty clear. Single assets, no matter how great they seem, are almost never on that efficient frontier.
They're suboptimal.
So even if an asset looks fantastic by itself, you have to evaluate it based on how it impacts your entire portfolio. Does it add diversification? Does it enhance that overall risk-return balance? That's what matters.
That's the key question.
Now, what if you are comfortable with a bit more risk and you're aiming for those potentially higher returns?
Well, then Gruber talks about two tools that can amplify both your gains and your losses: short selling and borrowing.
Okay.
And just remember, any tool can be used wisely or recklessly. Think of it like a kitchen knife. It can be used to create a beautiful meal or, well, not something you want to think about.
So let's break these tools down carefully. First up, short selling. It's essentially betting that an asset will go down in price.
Right, right. You're borrowing shares of something you believe is going to decline in value. You sell those borrowed shares, and then later on, you buy them back at hopefully a lower price to return to the lender. If the price drops, as you predicted, you pocket the difference.
But if it goes up?
Well, you're on the hook for the difference. And potentially, those losses can be unlimited.
Then there's borrowing. It's kind of like using leverage to amplify your investment.
You think of it like this. You're borrowing money to invest more in the market. If the market rises, your returns are magnified because you're controlling more assets than you own outright.
But if the market takes a downturn...
Well, you're still responsible for repaying that loan, even if your investments have taken a hit.
So while these strategies can enhance returns, they're definitely not for the casual investor. You really have to know what you're doing.
Be prepared for that added risk.
Now, with all this talk about risk and return, we've got to discuss this key model in modern portfolio theory, the CAPM.
Ah, yes, the CAPM.
The capital asset pricing model. If I'm understanding this right, it's basically trying to figure out how much return you should expect for the level of risk you're taking.
That's the heart of it. The CAPM introduces this idea of beta to measure an investment sensitivity to those overall market movements. So a stock with a beta of 1 that tends to move in line with the market. A beta of 2 suggests it's twice as volatile.
Okay, so a higher beta, that means riskier, but with the potential for bigger gains, at least according to the CAPM.
In theory, yes.
So the CAPM provides a formula to calculate that expected return based on an asset's beta, the risk-free rate, think like government bonds,
Right.
and the expected return of the market portfolio.
The market portfolio.
Wait, market portfolio? That sounds like trying to fit every type of investment into one massive basket.
Yeah, it's kind of a theoretical concept. Imagine a portfolio that includes every single risky asset out there. Stocks, bonds, real estate, commodities, everything. That's your market portfolio.
Wow. That's a lot to keep track of.
It is, and that's one of the challenges with the CAPM, in practice. Perfectly replicating that theoretical market portfolio in the real world, it's pretty tricky.
Right.
But the model is still incredibly helpful for understanding that fundamental relationship between risk and return.
Okay. So we've gotten a good overview of the CAPM, but in your notes you mentioned that there are other models out there as well.
Oh, yeah.
And some of them seem to challenge the CAPM's assumptions, leading to some alternative views on how to build the optimal portfolio.
Definitely. For instance, one issue is that the CAPM assumes everyone can borrow money at the same, what we call risk-free rate.
Okay.
Which, in reality, that's not the case. Not everyone can borrow at the same rate as, say, the U.S. government.
I wish I could.
Right. So that's where the zero beta CAPM comes in. It suggests that even if you're, super risk averse, there might be better strategies than just parking all of your money in low-yield savings accounts.
Intriguing. What else do these alternative models factor in?
Well, one thing that the standard CAPM ignores is taxes.
Right.
And this can have a huge impact on your actual returns, especially if you're dealing with different tax rates for various types of income.
So a portfolio that looks fantastic before taxes, it might not be as appealing after factoring in those potential tax bills.
Exactly. And then there's inflation. The standard CAPM assumes everything's happening in nominal terms, not considering how inflation erodes that purchasing power over time. And if inflation is unpredictable, well, then a nominally risk-free asset, it's not truly risk-free in real terms.
So you could think you're winning the game with a pile of points, only to realize those points are in a currency that's about to become worthless.
Perfect analogy. These alternative models really emphasize the need to look beyond just the mean and variance when you're structuring your portfolio.
And that there might not be a single right answer for every single investor?
Yeah.
So your optimal portfolio, that could depend on your tax situation, how long you plan to invest, your comfort with risk, even things like, other income sources you might have.
It's all connected.
This is fascinating stuff, but we should probably pause here for now,
Yeah,
and we'll pick this up in part 2 of our deep dive.
sounds good. So picking up where we left off, you mentioned in your notes some questions about this idea of efficient markets.
Yeah, that really stood out to me too. It's this concept that information is reflected in asset prices almost immediately and accurately.
Think of it this way. Imagine a company announces, just blockbuster earnings.
Right.
Efficient market theory suggests that that stock price is going to jump almost instantly to reflect that good news.
So unless you've got a time machine or some serious insider knowledge,
Right.
trying to predict those future price movements based on, publicly available information is a waste of time.
It's like trying to get like a scoop of ice cream from a container that's already been like perfectly licked clean.
Huh. Okay. So where does that leave someone who is actively trying to manage their portfolio?
Right.
If markets are truly efficient, wouldn't it be better to just passively track an index?
Well, the idea of perfectly efficient markets, it's a bit of a theoretical ideal.
Okay.
Gruber does acknowledge that there's some evidence of what are called market inefficiencies, or sometimes people call them anomalies.
Right.
And this is where things get a bit more interesting for folks who believe in that active management.
Ah, so there might be cracks in that perfectly licked ice cream container after all.
Perhaps, perhaps. One well-known anomaly is the size effect,
Okay.
where, smaller companies, they tend to outperform those larger companies over the long term, even after you adjust for risk.
And there's also the PE effect, right?
Right.
Where companies with a low price to earnings ratio seem to do better than those with a high PE ratio.
Exactly. And both of these effects, they're kind of puzzling because, in theory, that information about a company's size or its PE ratio,
Yeah.
it should already be baked into the price.
Right.
If markets were truly efficient, these effects wouldn't exist.
So maybe there are opportunities for, those skilled investors to exploit these anomalies to actually outperform the market after all.
It's like finding that, that hidden stash of sprinkles in the back of the ice cream container.
The existence of these anomalies, it does suggest that markets, maybe they're not perfectly efficient.
Right.
But we got to remember these are long-term statistical observations, not guarantees.
Not guarantees at all.
And even if these anomalies persist, consistently exploiting them requires skill, research, and let's be honest, a bit of luck.
Definitely luck. It's not easy.
That leads to another key idea from Gruber's work. Understanding the purpose of different securities and investment techniques.
So,
It's not just about what you invest in, it's also about the why and the how.
the why and the how, yeah.
He uses this example of artificial options,
Artificial options.
where you can mimic the behavior of a put option on your portfolio by dynamically adjusting your mix of, say, stocks and treasury bills.
So even something seemingly simple, like holding treasury bills, it might even be part of a more complex strategy. It's like judging a recipe based on a single ingredient without considering how it all comes together.
Right.
He also really stresses this importance of avoiding what he calls dominated securities,
Okay.
which are basically investments that offer a lower return for the same or higher level of risk compared to other available options. It just doesn't make sense.
Why choose a bumpy, slow bus route when there's a high-speed train that gets you to the same destination faster and more comfortably?
Exactly. For instance, why would you buy a corporate bond with a lower yield than a government bond with the same maturity unless there's some unique tax advantage or other factor at play?
So you're saying we got to compare our options and make sure we're not settling for a dominated investment.
Be a savvy investor. Understand the tools and make sure your choices are really aligning with your goals.
All right, so let's walk through the process of actually building a portfolio, putting these theories into action.
Okay.
Gruber is very adamant about starting with clear, well-defined goals, beyond just, I want to be rich.
You got to quantify those goals.
Huh.
For example, I want to retire comfortably at 65 with a portfolio that can generate $50,000 a year in income.
Okay.
That forces you to be realistic about that trade-off between risk and return.
And those goals should consider other factors as well, right? Like your liquidity needs, your tax situation, any, unique economic circumstances that might be impacting your finances.
It's about tailoring that portfolio to your life.
Right.
A young professional just starting out, they probably have a very different time horizon and risk tolerance than, someone nearing retirement.
Right. So once you've got those specific goals laid out, then what?
Then you develop a passive strategy that is aligned with those goals.
Okay.
And that serves as your benchmark or your starting point. It's like, what would you do if you didn't have any special insights or skills?
So for someone aiming for, long-term growth with moderate risk, a passive strategy might be investing in a globally diversified portfolio of stocks and bonds, and then adjusting periodically to maintain their desired balance.
That's a good example.
Okay.
Then from there, you can decide, do I want to deviate from that passive strategy with any active management?
But as we've been discussing, the more you stray from that passive approach, the more evidence you need to justify those moves.
Exactly. If you're going to hire an active manager or try to time the market yourself, you need solid reasoning and evidence to back up your decisions.
Because you're taking on additional risk and cost. So there needs to be a clear potential benefit.
It's got to be worth it.
So if you're thinking about, hiring a manager who focuses on, say, emerging market stocks,
Yeah.
you got to ask yourself some tough questions. Does this manager truly have a demonstrable skill?
Right. A track record.
Are their fees justified by their potential to outperform?
And most importantly, how does adding this manager impact your overall portfolio's risk and return?
So even if they're a, genius stock picker,
Right.
if their strategy adds a bunch of unnecessary risk to my portfolio,
Right.
it might not be worth it.
You got to look at the big picture.
And even then, you've got to monitor their performance over time, right?
Yes, of course.
Are they actually sticking to their stated strategy?
Are they consistently beating their benchmark? Are their fees still reasonable?
And if you're managing your own portfolio, the same principles apply.
Yeah, for sure.
You got to be honest with yourself about your abilities. Avoid those unnecessary risks or chasing those, latest investment fads.
Right. Be disciplined. Stick to your plan.
Now, Gruber goes into a lot of detail about selecting and monitoring investment managers, whether you're a big institution or an individual building your personal portfolio.
He stresses looking beyond just that past performance.
Okay.
You got to dig deeper, understand the manager's philosophy, their process, their historical track record. How do they align with your overall portfolio and goals?
It's like choosing any professional. A doctor, a lawyer, a plumber, you name it. You wouldn't just pick someone randomly based on a, flashy advertisement, would you?
You want to do your research, check references, understand their approach, make sure they're a good fit.
Exactly. That same due diligence applies to investment managers. You need to be an informed investor asking the right questions, making sure you're getting what you pay for.
Now, let's shift gears a bit and talk about some broader implications of modern portfolio theory. The importance of the investor's time horizon really stood out to me.
Because an investment that's perfectly reasonable for someone with a 30-year time horizon might be extremely risky for someone who needs to access that money in just a couple of years.
Huge difference. A 30-year treasury bond could be a solid choice for someone saving for retirement decades from now, but could be a disaster for someone who needs cash for a down payment on a house next year.
Right, because if interest rates spike, the value of that bond could plummet,
Ouch.
leaving them with a big loss right when they need the money the most.
It all comes back to aligning your strategy with your time horizon.
And that kind of brings up this other crucial concept, risk preference.
Yeah.
Because even if two people have the same time horizon, they might have wildly different comfort levels with seeing those portfolio values fluctuate.
Some folks are thrill seekers. They're happy to ride that stock market roller coaster.
Okay.
Others, they prefer a much smoother, more predictable ride. Modern portfolio theory really acknowledges that there's no right or wrong answer when it comes to risk preference.
It's about finding that sweet spot where you're comfortable with the potential ups and downs while still on track to reach your goals.
And remember, that comfort level can evolve too over time. As you approach retirement, for example, you might want to dial back the risk a bit.
So it's not a set it and forget it situation.
Yeah.
You got to review your risk tolerance and adjust your portfolio as needed.
Now, Gruber also talks about this concept of maximum loss, which is particularly relevant for folks with specific financial obligations they need to meet.
You're talking about situations where you absolutely have to have a certain amount of money available at a particular time, like for, say, a down payment on a house or your child's college tuition.
Exactly, yeah. In those cases, you can't just hope everything's going to work out perfectly.
Right.
You need a plan that acknowledges that potential for a downturn.
Gruber suggests considering maybe like a two-portfolio approach,
Okay.
where one portfolio is focused on those low-risk guaranteed investments to meet those like specific needs, and then the other portfolio is geared towards those higher potential returns with that longer time horizon.
It's like having a separate emergency fund for your investments,
Okay.
making sure those essential goals are covered, even if the market throws you a curveball.
Hmm.
He also mentions potentially using option strategies, like buying put options, to protect against those potential losses.
But the strategies can get pretty complex, right?
They can be. The key is understanding there's an imbalance in those potential outcomes. The negative impact of not meeting your essential financial needs, that's far greater than the positive feeling of exceeding them.
Then there's the question of liquidity, which Gruber highlights as another, essential consideration.
Some investments, like those publicly traded stocks and bonds, they're easy to buy and sell quickly. They're very liquid.
Okay.
But others, like real estate or private equity, they might be much harder to sell when you need the cash.
So you got to strike a balance between pursuing those higher potential returns with illiquid assets and then having enough liquid assets to meet those unexpected expenses or opportunities.
It's about finding that optimal mix that aligns with your circumstances and goals.
Now, let's tie this back to the idea of prudence, this recurring theme in Gruber's work.
Yeah.
Remember, he's writing for fiduciaries, those responsible for managing other people's money.
Right.
He argues that modern portfolio theory provides this framework for making those prudent investment choices.
It's not about being risk-averse to the extreme. It's about understanding those trade-offs, diversifying thoughtfully, aligning your strategy with your goals, and most importantly, being able to justify your decisions.
So are you saying some traditional notions of prudence, like never borrowing money or completely avoiding certain asset classes, might actually be less prudent in the context of modern portfolio theory?
He suggests that blindly following those old rules, it could actually prevent you from achieving the best possible outcomes for the people whose money you're managing.
It's about being open to new ideas and approaches while still grounding those decisions in, solid principles and evidence.
That brings us to another point that Gruber really emphasizes, the need for continuous monitoring and evaluation.
So it's not a set it and forget it kind of deal. You got to actively manage your portfolio even after you've established a strategy.
You got to keep track of your portfolio's performance, review your goals and risk tolerance, periodically, and be prepared to adapt.
Because the market's always changing, so your approach should be as well. It's like driving a car. You don't just set your course and close your eyes.
You got to pay attention to the road, adjust your steering, react to those changing conditions to reach your destination safely.
All right, we've covered a ton of ground, exploring these core concepts and principles of modern portfolio theory. But before we wrap up, are there any criticisms or limitations to this approach?
Of course, no single framework is perfect. One common criticism is this reliance on historical data to predict future returns and risks.
Like they say, past performance is no guarantee of future results, especially in investing, where those markets are constantly shifting.
Exactly. And even with those sophisticated forecasting models, there's always going to be some uncertainty.
Okay.
So how do you deal with that uncertainty when you're building a portfolio?
So instead of expecting a precise return, it's more realistic to use a range of potential returns. So instead of saying, I expect the stock market to return 8% next year, I might say, I think the return will be somewhere between 5% and 11%.
Exactly. Using a range of potential outcomes, it lets you assess the upside and the downside of your portfolio under those different scenarios. And it helps you determine how much risk you're willing to take.
So if I'm comfortable with the possibility of a 5% return, I might be willing to take on more risk than someone who needs at least an 8% return to meet their goals.
Another challenge is estimating those correlations between different assets, which is crucial for diversification. Or hoping, different assets don't move perfectly in sync. That's the whole point of spreading your risk.
So if you're combining stocks and bonds in your portfolio, you're hoping that when stocks take a hit, bonds will either go up or at least not fall as much.
Right. But those correlations, they can change. And sometimes assets that were previously uncorrelated, they suddenly start moving in the same direction.
Like during the 2008 financial crisis, almost every asset class went down.
Exactly. You got to be aware that historical correlations, they're not guarantees. Be prepared to adjust your portfolio if those relationships change.
And that brings up another practical challenge, rebalancing.
Even with a well-diversified portfolio, over time, your target asset allocation is going to drift as different assets perform differently.
Okay, so if, stocks have a stellar year and bonds lag, you might end up with a much higher allocation to stocks than you initially planned for.
You might be taking on more risk than you're comfortable with without even realizing it.
So you need to periodically rebalance by selling some of your winners and buying more of your laggards.
Exactly. Bring that asset allocation back in line.
How often should you rebalance? Is there like a set schedule?
It depends. It depends on your risk tolerance, your time horizon, the transaction costs. It could be annually, quarterly, or just when your portfolio drifts too far.
Now let's talk about taxes. You mentioned this earlier that the standard CAPM ignores taxes,
Right.
but they can have a huge impact on your actual returns, especially if you're investing outside of a tax-advantaged account.
Different types of income are taxed differently. Interest income is usually taxed at your ordinary income tax rate, but qualified dividends and long-term capital gains, they're often taxed at a lower rate,
Okay, so it's important to consider those tax implications of your investment decisions.
especially if you're in a high tax bracket.
So if you're choosing between two similar investments, one that generates mostly interest income and the other generates, qualified dividends or long-term capital gains, you might prefer that second one to minimize your tax liability.
Absolutely. You might also look into strategies like tax loss harvesting, where you sell losing investments to offset capital gains.
So tax efficiency can be a tiebreaker when you're choosing between similar investments.
There can be.
But at the end of the day, those taxes, they shouldn't be the primary driver of your investment choices.
Focus on investments that you believe will generate the best after-tax return over the long term, even if they might have a slightly higher tax bill in the short term. Don't let the tax tail wag the investment dog.
Now let's move on to this fascinating aspect of investing that Gruber touches on, behavioral finance, which explores how our psychology, our human nature, can influence our investment choices.
Modern portfolio theory, it kind of assumes investors are perfectly rational, always seeking to maximize their return for a given level of risk. But in the real world, we're all subject to emotions and biases,
Right.
and that can impact our decisions, even when it comes to money.
We might get caught up in FOMO, fear of missing out, and buy stocks that are just skyrocketing, even if they're overvalued.
Or panic and sell our investments at the worst possible time, locking in losses.
Right, and we might be overconfident in our abilities, taking on more risk than we can handle, or making those impulsive trades based on gut feelings.
The key is to be aware of these biases. Once you recognize those tendencies, you can develop strategies to counter them.
So if I know that I'm prone to, FOMO,
Okay.
I might set strict rules for myself about when I'm allowed to buy a stock, like waiting for a price dip or really doing thorough research before investing.
And if you tend to panic sell, you might commit to a long-term plan and avoid checking your portfolio too frequently,
Okay.
especially during those volatile periods. It's like shielding yourself from the noise and focusing on that long-term signal.
And having a trusted advisor or friend to offer an objective perspective,
That can help too, definitely.
that can help you stay disciplined and avoid those emotional decisions.
Sometimes just talking it through with someone else can help you spot your biases and make better choices.
Now, as we delve deeper into modern portfolio theory, we should also acknowledge its limitations and potential future developments. One area that's gaining a lot of traction is the role of technology in portfolio management.
Yeah, we're seeing this rise in robo-advisors and automated investment platforms that are using algorithms and artificial intelligence to create and manage portfolios.
Right.
They often charge lower fees than traditional advisors and can be a great option for folks who are tech-savvy and prefer a more hands-off approach.
But robo-advisors, they're still relatively new, and it remains to be seen how they'll perform over the long term, especially during periods of market turmoil.
And they might not be suitable for investors with more complex situations, or those who need personalized advice that goes beyond what an algorithm can provide.
Another trend that we're seeing is this increasing interest in alternative investments, things like private equity, hedge funds, real estate.
Right, they have the potential to deliver those higher returns than your traditional stocks and bonds.
But they also come with higher risks and often, require a significant minimum investment.
They're not for everyone, especially for folks with those shorter time horizons.
But for investors who are looking to diversify their portfolios beyond those traditional assets, alternative investments can be worth exploring as long as you understand the risks involved.
Absolutely. Understand those risks.
As the world becomes more interconnected, there's also a growing interest in global investing.
Yeah. Investing in international markets can offer those diversification benefits and exposure to new growth opportunities.
But global investing also carries its own set of risks.
Of course,
Currency fluctuations, political instability, things like that.
you got to do your homework. Understand the risks and the rewards before jumping in.
And with that growing concern about, climate change and sustainability, we're seeing a surge in this impact investing.
Yeah, impact investing goes beyond just financial returns. It's about using your capital to support companies that are actively trying to address these social and environmental challenges.
So it's not simply charity.
No. Impact investing aims to achieve both financial returns and a positive impact.
Okay.
And it's attracting interest from a wide range of investors.
So as you can see, modern portfolio theory, it's not some static concept. It's constantly evolving.
You've got to adapt to new challenges, new opportunities, new ways of thinking.
It's an exciting time to be learning about investing as we explore new ways to apply these principles.
Build those portfolios that are both financially sound and align with our values.
All right, so we've delved deep into modern portfolio theory, from the fundamentals to those complexities, and even touched upon the criticisms and future trends. But, before we wrap up, I'm curious, what steps can we take to continue learning and growing as investors?
It's a lifelong journey. Staying informed about market trends is crucial. We can read, financial news, listen to podcasts, attend industry events.
And connecting with other investors, learning from their experiences.
Join investment clubs, participate in webinars, engage in those online forums. Sharing knowledge is so powerful.
And of course, we can continue to educate ourselves about different strategies and products, reading, taking courses, earning those certifications.
But most importantly, you got to be open to experimenting and learning from mistakes. That's how you gain experience.
So as we conclude this deep dive, let's leave our listeners with a thought-provoking question. You've learned about diversification, the risk-return trade-off, market inefficiencies, and a whole lot more. What excites you the most about modern portfolio theory? What will you explore further?
Yeah, that's a great question to think about. As we've been talking about, modern portfolio theory gives us a really solid framework.
Yeah.
But it's also kind of a starting point, right?
For exploration, yeah.
It's like having, like a well-stocked toolbox.
Okay.
You've got to choose the right tools and apply them to whatever your specific project is.
Right. The right tool for the job.
I'm personally fascinated by this whole idea of market inefficiencies. Like, maybe there are still opportunities to kind of outsmart the market if you know what you're looking for.
Mm-hmm.
That's the holy grail for a lot of investors.
Right.
But as we said, even if these inefficiencies exist,
Right.
consistently exploiting them, it's not easy.
Yeah.
It takes a ton of research, a really disciplined approach.
And got to remember that even the most brilliant strategies, they can get totally derailed by our own, behavioral biases.
Oh, for sure. Fear, greed, overconfidence, all that stuff
Right.
can lead to those bad decisions.
Undermine our long-term goals.
Exactly.
That's why it's so important to have a plan, to stick to that plan.
Right.
And maybe even have like a trusted advisor, a friend to bounce ideas off.
Someone to give you that objective perspective.
Because investing really is both an art and a science.
I like that.
Yeah.
Yeah, it's true.
It blends analytical thinking, but also requires an understanding of how we behave as humans.
Our psychology, yeah.
It's been a fascinating deep dive, really unpacking these concepts and kind of challenging our assumptions about, how markets work and how we should be approaching investing.
We've covered a lot, yeah.
From, those fundamental principles of diversification, risk and return, to the much more complex side of, building portfolios, market efficiency, behavioral finance, and even a little peek into the future of investing.
It's a lot to think about.
I think what really stands out to me, though, is this emphasis on truly understanding the why behind your investment choices.
The why.
It's not just about blindly following the herd or chasing the hot stock tip.
No, not at all.
It's about really taking ownership of your financial future.
Absolutely.
Developing your own philosophy and making sure every decision lines up with your goals, your risk tolerance, your time horizon.
And I think what's also important is remembering that investing is a continuous process. It's not one and done.
Right, you're always learning.
The markets change. We as investors, we have to change with them.
Now, you mentioned in your research that you were particularly interested in this concept of factor investing, which seems to be gaining popularity as a way to potentially, get those better returns and manage risk better.
It's definitely getting more attention, yeah.
So factor investing, it kind of goes beyond that, traditional market cap weighted indexing.
Right.
Right. It's about tilting your portfolio towards specific factors.
Things like value, momentum, quality, size
Okay.
that have historically shown to lead to higher returns.
It's like adding this extra layer of analysis to your decisions. You're not just looking at company names and stock prices. You're thinking about the characteristics that might drive performance in the future.
Looking under the hood, so to speak.
There's more research coming out that seems to support, the idea that factor investing works, but it's still pretty new.
And as with any investment strategy, there are risks involved. And just because something worked in the past doesn't mean it'll work in the future.
Right. But if you are interested in this idea of maybe boosting your returns by tilting your portfolio towards those specific factors, it's worth looking into more.
Yeah, definitely. Do your research.
So as we wrap up our deep dive into modern portfolio theory, we really want to encourage you to continue learning.
Yeah, keep exploring.
Explore, refine your approach to investing.
And most importantly, enjoy the journey.
Remember, it is a journey,
It's not a destination.
not a destination. The more you learn, the more confident you'll be in making those smart decisions, the ones that align with your goals.
Your aspirations.
We hope that this deep dive has given you the knowledge and tools to navigate this complex world of investing with more clarity.
And purpose.
Absolutely. Until next time, happy investing.
Happy investing.